Most people, when they find out what the full state pension pays, feel a small wave of relief. £12,548 a year. That is the number for 2026 to 2027. You worked for it. You paid in. It is yours. And then someone sits down and does a very quiet piece of arithmetic, and the relief starts to curdle. Your personal allowance, the amount of income HMRC lets you earn before they take a single penny in tax. That figure is £12,570. Subtract one from the other. £12,570 minus £12,548. That leaves you £22. £22 of tax-free headroom for the entire year. Less than the cost of a decent bottle of wine. What that means in practice is this. The moment you take any money out of a private pension, a SIPP, a workplace pot, a drawdown account, HMRC is already waiting. There is almost no buffer left. Every pound you pull out gets taxed from essentially the first pound. Not from some high threshold, the first pound. A lot of people do not realize this until it is too late to do much about it. And that is exactly why the state pension is not just another welfare line in your personal budget. It is the number that shapes every other financial decision you make in retirement. It is the foundation, and right now, for most new retirees, that foundation is quietly eating their tax-free allowance whole. Today we are going to go through the 5 biggest mistakes people make around the state pension. If you have not subscribed yet, now is a good time, because this channel spends a lot of time in the details that most financial content in the UK skips entirely. Here is something most people assume without ever checking. They have worked for 30, 35, sometimes 40 years. They paid their national insurance every month. So when the time comes, the government has all of that recorded correctly. Every job, every employer, every year. HMRC and DWP talk to each other. It is all joined up. Except it often is not. David is 62. He spent his career as an engineer up in Leeds. Never had a gap year, never went self-employed, never took extended time off. By his own count, he had well over 35 qualifying years. More than enough for the full pension. He only went on to gov.uk to check his state pension forecast as a formality, really, just to confirm the number he already expected to see. He found 3 missing years. What had happened was unremarkable, which is almost the point. A job change in his late 30s. His old employer had submitted his national insurance contributions under a slightly incorrect reference. The years sat there, unattributed, invisible to his record. Nobody flagged it. Nobody chased it. It just quietly disappeared. This is not unusual. It happens more than people realize, and the system is not built to alert you when it does. Now the maths on this matters. Under the 2026 to 2027 rates, each missing qualifying year costs you roughly £358 a year in state pension. For life. Buying that year back through voluntary Class 3 national insurance contributions costs around £956. Your break-even point is less than 3 years. After that, every year you are alive, you are in profit. I have been close to this myself. The first time I went onto the government website to check my own record, I found 2 years marked as not full. I was fairly sure I had worked those years. I remembered them clearly. Turned out one was a recording issue, one was genuine. Either way, it was not something I would have known without looking, and that is the problem with leaving it. The deadline for buying back certain missing years under the transitional arrangements has already shifted once. The window is not permanently open. If you are in your late 50s or early 60s and you have not checked your national insurance record on gov.uk, that is the single most valuable 10 minutes you can spend this week. Not next month. This week. You need 35 qualifying years for the full new state pension. The minimum to receive anything at all is 10 years. If you land somewhere in between, your pension is reduced proportionally. There is no rounding up, no goodwill adjustment. The system pays out exactly what the record says. Your employment history, your self-employed periods, years spent caring for someone, all of these can generate NI credits, but only if they were recorded correctly at the time. Gaps appear for mundane reasons, and the system does not tell you when it happens. But missing years are not what I hear about most from people watching this channel. The thing that genuinely causes confusion, the thing that keeps people up at night wondering whether they are somehow permanently penalized, is two words they find on their forecast and do not understand. Contracted out. If you have checked your state pension forecast on gov.uk and seen a line that says something like, "You've been in a contracted out pension scheme," you may have felt a drop in your stomach. It sounds like a penalty. It reads like a permanent mark against you. And for a lot of people, the instinct is to fix it fast, by reaching for their savings and buying back missing years before retirement arrives. David did exactly that. He rang his financial advisor in something close to a panic. He had seen the contracted out deduction on his forecast, worked out the gap between what he was on track to receive and the full £12,548, and was already calculating how many years he needed to buy back and what it would cost him. His advisor stopped him, because what the forecast does not clearly explain, and what most people never find out until they either ask the right person or stumble across it, is that contracting out works very differently from a simple shortfall in your NI record. Here is what actually happened between the 1970s and 2016. If you were a member of a workplace pension scheme, particularly a defined benefit or final salary scheme, there was a deal struck between your employer and the government. Your employer's pension promised to pay you a portion of what the state pension would have paid, called the Contracted Out Pension Equivalent, or COPE. In exchange, both you and your employer paid lower national insurance contributions during those years. The government, in effect, said, "Your employer is covering part of our job, so you both pay less in." When the new state pension launched in April 2016, everyone's record was assessed. If you had been contracted out, your starting amount, the figure used to calculate your new state pension entitlement, was reduced to reflect those lower contributions. That reduction is what you are seeing on your forecast. It is not an error. It is not a punishment. It is an accounting adjustment for a deal that was made decades ago, often without you having much say in it. But here is the part that changes everything. Any full qualifying year you accumulate after the 6th of April 2016, whether through employment, self-employment or certain NI credits, adds approximately £6.58 per week to your starting amount every single year, automatically, without you doing anything extra. What that means in practice is that the contracted out deduction is not fixed. It is not a permanent ceiling. It erodes. Year by year, each qualifying year since 2016 acts as a mathematical buffer, quietly working against the deduction until your pension reaches the maximum. The system was designed this way, deliberately, as part of the transition to the new rules. If David is 62 and still working, and he has been accumulating qualifying years since 2016, the contracted out gap on his forecast is already smaller than it was. And depending on how many years he has left before he draws his pension, it may close entirely without him spending a single pound of his savings. Buying voluntary contributions on top of that, while those working years are already doing the job, is paying twice for the same result. The money leaves his account. The gap closes at exactly the same rate it would have anyway. So if you are in your late 50s, still employed, and you saw contracted out on your forecast and started mentally pricing up voluntary NI contributions, pause. Log back into gov.uk. Look at how many qualifying years you already have post-April 2016. Run the projection forward to your state pension age. In many cases, the gap closes on its own. That does not mean voluntary contributions are never worth it. If you have genuine missing years from before 2016, or if you left employment early and the post-2016 buffer will not be enough, buying back years can still make very strong financial sense. The ROI we looked at in the last section holds. But the decision has to start with understanding the mechanism, not reacting to a number on a screen. Contracted out is not a trap. Misunderstanding it is. And once you have worked through all of this, once you are satisfied that your NI record is clean, your contracted out position is understood, and you are on track for the full £12,548. That is precisely when HMRC has something else waiting for you. Something much quieter and considerably more expensive. Sarah turned 66 this year. She had done most things right. She had checked her NI record. She had her full 35 qualifying years. She had a SIPP she had been contributing to since her mid-40s, and it had grown into something she was quietly proud of. When she finally handed in her notice, she had a plan. Her first act of retirement was going to be a proper holiday. Something she and her husband had been putting off for years. She was going to pull £10,000 from her pension pot and spend it without guilt. The tax bill arrived. It was £2,000. She had not expected that. Not on the first withdrawal. Not when she had a personal allowance, a threshold the government promises every UK resident of £12,570. What she had not fully accounted for was that her state pension had already arrived first, £12,548 a year. Paid gross, directly into her account, every 4 weeks. It counts as taxable income. It sits at the bottom of her income stack, whether she wants it there or not. And when you subtract £12,548 from a personal allowance of £12,570, you are left with £22 of tax-free space. For everything else. So when Sarah drew £10,000 from her SIPP, HMRC did not see a retiree making a modest, careful withdrawal from her own savings. They saw £10,000 of income sitting well above her personal allowance and taxed it accordingly. £2,000 gone. Not to some technical error, not to a loophole, just to a structural reality that nobody had explained to her clearly before she retired. If that £10,000 had been sitting in an ISA rather than a pension pot, the tax bill would have been exactly £0. ISA withdrawals do not count as income. They do not touch your personal allowance. They are completely invisible to HMRC. That difference, £2,000 on a single £10,000 withdrawal, is not small. Across a retirement of 20 or 25 years, if Sarah keeps drawing from her SIPP at that rate, the cumulative tax drag is significant, and it compounds because every pound she pays in tax is a pound that cannot grow further, cannot be passed on, cannot do anything useful for her at all. I held this belief myself when I was starting out, that the state pension was somehow separate, almost protected, that the government would not count it against you in the same breath as taxing your savings. It took me longer than it should have to understand that HMRC does not make those distinctions. Income is income. The source does not change the treatment. The personal allowance freeze makes this sharper. The threshold has been stuck at £12,570 since 2021, and it is set to remain frozen until at least 2028. Meanwhile, the state pension rises each year under the triple lock. The gap between the two is narrowing. Some projections suggest the state pension alone could breach the personal allowance before the end of the decade, at which point someone with no other income will owe tax on it. That is worth understanding now, while there is still time to act. The tool that most effectively addresses this is what some planners call income smoothing, and the window for it is the years between roughly 60 and 65, before your state pension starts. If you have funds sitting in a pension pot and you have retired early or reduced your hours, those years are often lower income years. Your personal allowance is largely intact. Drawing down gradually from your pension during that period, taking amounts that stay within your tax-free threshold, and moving that money into an ISA shifts the asset from a taxable environment to a tax-free one. Permanently. The state pension has not arrived yet to compete for that allowance. The window is open. Once you turn 66 and the state pension begins, that window is effectively closed. The allowance is gone. Everything drawn from the pension after that point costs you, at minimum, 20% in tax. Potentially 40% if other income pushes you higher. 10 minutes with a calculator before 66 can be worth thousands of pounds. That is not an exaggeration. Many people encounter this and think, well, the simple solution is to just delay taking the state pension altogether. Skip it for a year or two, Rebuild some breathing room. It sounds logical, and it might be, depending on one variable that none of us can know in advance. Deferring your state pension is straightforward in principle. For every year you delay claiming past your state pension age, your eventual payment increases by 5.8%. Put off taking it for a year, and instead of £12,548, you receive roughly £13,275 when you do start. That sounds attractive. An extra £727 a year, inflation protected, for the rest of your life. But there is a number buried in that deal that changes the conversation entirely. To break even on a 1-year deferral, you need to live for approximately 17 years beyond your state pension age. In other words, you need to reach somewhere between 83 and 84. According to ONS life expectancy tables, the average 66-year-old man in the UK can expect to live to around 84, the average woman to around 86. So on the numbers alone, deferral is not obviously wrong. For some people, statistically, it roughly washes out. But averages hide a great deal. If you are in good health and your family tends towards longevity, the maths may work in your favour. If you have a chronic condition, or you have watched your parents and older siblings age earlier than expected, the calculation looks very different. You are not betting on the UK average. You are betting on yourself specifically, and that is a bet only you can assess. I was having tea with a friend recently. He had just lost his older brother, suddenly at 64, no warning. My friend is 61. He told me very quietly that the experience had changed how he thinks about money entirely. He said he was done optimizing for 85. He wanted to know he had actually used what he had saved while he was well enough to enjoy it. Not because he had given up on planning, but because he had been reminded, in the hardest possible way, that the plan has to account for the fact that things do not always go to plan. I am not going to tell you that feeling is wrong. It is not. There is also an inheritance dimension that rarely gets discussed clearly. If you defer and then die before you have broken even, the years of missed pension income simply disappear. Unlike a pension pot, a deferred state pension does not form part of your estate. There is nothing to pass on. The government does not send your family a check for the years you chose to wait. For some people, deferral does make genuine sense. If you are still working at 66 and earning a reasonable salary, adding state pension income on top would push you into a higher tax band, or at least deepen the tax drag we covered in the last section. In that specific situation, deferring until you actually stop working can be a reasonable choice. You avoid the tax now, and you receive a slightly higher payment once your other income has dropped. The other version, deferring simply because someone told you it is what financially savvy people do without running the actual calculation, is where things go wrong. Deferral is not inherently clever. It is a trade with a specific cost and a specific payoff, and whether it makes sense depends almost entirely on how long you live. The only question is whether, based on your health and family history, 17 years is a reasonable expectation. If the answer is yes, deferral may be worth considering, particularly if you are still earning, and the tax position makes taking it now genuinely unattractive. If the answer is uncertain, or no, taking your state pension at 66 and investing or spending it thoughtfully is not a failure of planning. It is planning. Before we move on, drop a comment below. Are you team claim it immediately, or team defer and wait for the higher amount? I am genuinely curious where people land on this one, because the answer tends to say a lot about how someone thinks about risk. There is one more barrier worth examining, though, and it is not mathematical at all. It is something I see in the comments on almost every video about the state pension, a belief that quietly stops people from doing anything at all. If you spend any time in the comments section of videos about the state pension, and I spend quite a lot of time there, you start to notice a pattern. Someone explains the NI top-up maths, the break-even point, the ISA strategy, and then, reliably, a comment appears that goes something like this: "Why bother? They will means test it within 5 years." Or, "I am not paying another penny in. By the time I retire, they will have abolished it entirely." It is remarkably consistent. and I understand where it comes from. There is something psychologically coherent about this position. If the system is going to fail you regardless, then not engaging with it is not laziness, it is self-protection. You are not losing, you are opting out of a rigged game. It feels rational, it even feels a little defiant, but it is costing people real money. The state pension currently costs the UK government over £130 billion a year. That figure comes from DWP spending data, and it is worth sitting with for a moment. £130 billion. It is the single largest item in the government's welfare budget. It reaches tens of millions of voters, people who are politically active, who turn out at elections at a higher rate than almost any other demographic, and who remember very clearly what politicians promised them. Means testing the state pension would be one of the most politically explosive decisions any government could make. That does not mean it is impossible, but it means the incentive structure runs strongly against it. Governments of all parties have protected the triple lock, often at considerable cost, precisely because the electoral mathematics make cutting it extremely dangerous. The skepticism is understandable, the complacency it produces is not, because here is what actually happens when someone convinces themselves that the system is too uncertain to bother with. They do not check their NI record. They do not buy back the missing years that would cost them less than £1,000 and pay back within 3 years. They do not move assets into an ISA during the gap years before 66. They do not defer strategically, or claim strategically, or do anything at all, because they have decided in advance that the whole thing is probably pointless. And then they retire, and the state pension is still there. And they are receiving less of it than they should, paying more tax on it than they needed to, and there is nothing left to do about it. The irony is that the people most vocally convinced the government will take their pension are often the same people doing the least to protect what they are already entitled to under current law. The conspiracy becomes a reason not to act, and not acting guarantees a worse outcome regardless of what happens in Westminster. Healthy skepticism about government policy is reasonable. It is British, frankly. But there is a difference between skepticism and paralysis. One keeps you alert, the other keeps you poor. The rules as they stand in 2026 reward people who check their records, who buy back qualifying years where it makes sense, who move money into the right wrappers before the tax trap closes. Those rules may change, but they are the rules now. And now is when the decisions still matter. None of what we have covered today is complicated, in the way that financial planning sometimes gets made to appear complicated. There are no exotic products here, no specialist accounts you need a broker to open, no strategies that require a wealth manager on retainer. There are 3 things. Do them in order. First, go to gov.uk and check your national insurance record. Not next week, today if you can. Look at how many qualifying years you have. Look for any years marked as gaps or not full. If you find missing years, use the government's own checker to see whether buying them back is worth it for your situation. And remember the maths. Roughly £956 buys back a year worth £358 annually, and you break even in under 3 years. Second, if your record shows you were contracted out, do not panic and do not rush to spend. Check how many qualifying years you have accumulated since the 6th of April 2016. Each of those years is already working as a buffer against that deduction, adding approximately £6.58 per week to your starting amount. In many cases, the gap closes on its own before you reach state pension age. Third, if you are between 60 and 65 and you have assets sitting in a pension pot, start thinking seriously about income smoothing. Draw down gradually into an ISA while your personal allowance is still largely intact. Move the money into a tax-free environment before the state pension arrives at 66 and occupies £12,548 of your allowance. The window for doing this is finite, and it closes quietly. 10 minutes on the government website today. A conversation with a financial advisor about your specific drawdown position. An ISA opened and funded before your next birthday if you are in that 60 to 65 window. That is the whole framework. I am not going to pretend I have a crystal ball about what the rules look like in a decade. I do not know what future governments will do with the triple lock, the personal allowance freeze, or the pension tax relief system. Nobody does. But I do know what the rules say in 2026. And in 2026 they reward people who pay attention and act on what they know now. If this video helped you understand the contracted-out mechanism or made the £22 tax trap feel a little less abstract, pass it on to someone who is approaching retirement and probably has not thought about any of this yet. And if you have not subscribed, now is a good moment. This channel covers exactly this kind of detail, regularly, without the jargon. See you in the next one.